Hi there, you are welcome to Great Thinkers Academy. Great Thinkers Academy is a platform that offers online tutoring sessions. Are you a student preparing for ICANN ETS 1 or 2? And you are struggling with basic accounting, economics, quantitative analysis, or financial accounting? I strongly advise you join our specialized tutorial sessions designed to help you understand easily, pass confidently, and excel effortlessly. You can contact us by the phone number projected and the email on our flyer. So let's get to today. Today we'll be looking at financial accounting, and our topic will be the introduction to accounting. Let me just make this little disclaimer that all that we'll be discussing is based on the ICANN study pack, and it is based on the revised 2025 edition. So the objectives of today's lesson are the definition of accounting, objectives of accounting, types of accounting, difference between bookkeeping and accounting, roles of accountants in business, responsibilities of directors in relation to the financial statements, internal and external users of accounting information, the basis of accounting. We'll be looking at business. What exactly is business? What are the characteristics of business? And the features of each type of business. Let's get into it. So, first of all, what is accounting? Before I go further, for you being in ATS 2, it means that you have written ATS 1. And in ATS 1, definitely you would have come across basic accounting. And that is a prerequisite before coming into financial accounting. And the essence of you taking this course is to become AAT certified, meaning an associate accounting technician. And if you want to further going into the main ICANN, it means you plan or you have in mind to become ACA, which means an associate chartered accountant. Well, so what exactly is accounting? Why do you find yourself in this field? What exactly interests you? And this is what we'll be looking at. Some people have the mind that, oh, accounting only deals with numbers, accounting only deals with financial statements. But as we go in today's class, we see that there is more to that than what has already been said. So here we have it that accounting is the process of identifying, recording, classifying, reporting, and analyzing financial information of a business or organization. I would like us to take note of some keywords here: identifying, recording, classifying, reporting, and analyzing. And what exactly are they doing? Or what exactly is the basis of what they are doing? The financial information of a business organization. This financial information can be transactions that took place. This financial information can be anything. As we continue in our lesson today, we'll see exactly what they are. So identifying, you first need to identify such financial information, and usually it's always as a result of the transactions that the business always engages in. The next is recording. You record them by putting them in the books of original entry, the books of prime entry, and then you classify them, then you report on them through the financial statements as well as analyzing them. Let's go further. What are the objectives of accounting? The first we have here, recording financial transactions. The main objective of accounting is definitely to record financial transactions. Then we classify and report financial information, providing relevant and reliable financial information. There are a lot of users of this accounting information, and then we need to provide them with relevant and reliable sources assessing financial performance of the business, of the entity, or even a project, and compliance with laws and regulations. Going further, let's look at the types of accounting. It's not just the regular financial accounting that we know. There are more types of accounting. And the first here we have is financial accounting. And financial accounting involves preparing financial statements. And these financial statements can be the balance sheet, which is also known as the statement of financial position, as well as the income statement, which is the statement of profit or loss or other comprehensive income. And the main essence is to provide stakeholders with a clear picture of the company's financial performance and financial position. Apart from financial accounting, we as well have management accounting. And when we look at management accounting, we are talking about providing financial information to stakeholders in order to aid in decision making and strategic planning. So these managers, these other stakeholders, they need information to assist them in decision making and strategic planning. Next, we also too have cost accounting. Cost accounting, which you would realize is a course you will take in ATS 3, and cost accounting involves analyzing and reporting cost associated with producing goods or services, and cost accounting usually breaks down the cost into labor, materials and overhead cost. As well, we'll be looking at tax accounting, and this just includes preparing and filing of tax returns. Examples of tax: we have the value added tax, we have the personal income tax, we have the company income tax. Another type or branch of accounting, as we all know, is auditing. And auditing involves examining the financial statements and records, and this is to ensure that the financial statements present a true and a fair view. Afterwards, we are looking at forensic accounting. This involves using accounting skills to investigate financial crimes, and examples of these financial crimes are embezzlement, fraud and money laundering. As well, we also to have project accounting, and when we talk about project accounting, it involves tracking and reporting the financial performance of specific projects. For example, the construction of roads, the construction of bridges, all these deal with project accounting. And last year we have environmental accounting. As we look at the types of accounting, you notice that accounting spreads across all areas and it spread across all fields. And accounting also too gives cognizance not just to the present but also to looks at sustainability. And that environmental accounting involves measuring and reporting environmental impacts of an organization's activities. For example, the organization cannot just keep on having profits and this is affecting the natural habitat, or this is affecting the land, the sea, the air. So environmental accounting keys or takes attention of this. Going forward, let's look at the difference between bookkeeping and accounting. There are some times that you search for some job roles and such job roles are just limited to bookkeeping aside from accounting. So there is a major difference and there is more to it. Here we have it that bookkeeping is the first step in the accounting process, whereby transactions are entered into the accounting system to produce an accurate and complete record. Bookkeeping concentrates only on the record keeping, and I want us, as we go through this class and as accountants to understand that bookkeeping concentrates alone on record keeping, but accounting is more to it. Accounting is more broad than bookkeeping. Accounting includes not only the keeping of accounting records but also to the design of efficient accounting system, interpretation of accounts and development of forecast. If you look at the definition of accounting we gave earlier, we said accounting involves identifying. We said accounting involves recording. We said accounting involves classifying. We say accounting involves analyzing. So the financial information of the business of the organization goes beyond just keeping them in the books of accounts. It also too involves that we classify them. It also too involves that we analyze them, and that is where accounting comes into place. Going forward, let's look at the roles of accountants in business. And let me tell you and put it to you at this moment that in every organization, for such organization to be successful, we need an accountant there. And for such an organization to flourish and do meeting the stakeholders' expectation, we definitely need an accountant there. And the first one that we have as the role of an accountant is compliance. An accountant is involved in ensuring that a business complies with all aspects of company law. As accountants, it is expected that we are conversant with company laws, we are conversant with the Companies and Allied Matters Act, so that we can guide the business to ensure compliance with these laws and regulations. The next we have is strategy. So as an accountant, we are to provide analysis and insights during the formulation of business strategy. Strategy doesn't just look at the current term, strategy looks at the long term. Strategy looks at the resources of the organization and how the resources of the organization are able to contribute to the company's profits and overall sustainability. Also, the accountant is as well involved in planning, and the accountant does this through budgeting, through forecasting, and through consultation with everyone that is concerned. Other functions or roles of an accountant is control. The accountant assists in setting targets and monitoring and reporting on the performance of the business, the performance of staff, the performance of the vision of the organization. As well, the accountant is involved in decision making, and this decision making is based on relevant and reliable facts. The accountant is as well expected and is as well given the responsibility of preparing tax computations and providing relevant information to assist the business in filing its tax returns. And the last that we have here is that the accountants are treasury managers. They act as treasury managers, overseeing the financial management of the organization and how the organization is able to use the money that it has to move the business forward. Now let's go into the responsibilities of directors in relation to the financial statement. In every company, we always have the board of directors, and of course, as we continue, we will learn that the shareholders are different from the directors, and directors as well have a responsibility, and their responsibility as regards the financial statement is what we'll be looking at. The first responsibility that we have is that they have the responsibility to ensure financial statements are prepared in accordance with applicable framework, regulations, and legal requirements. So the responsibility of directors in this case is that they are to prepare, ensure that these financial statements are prepared, and this comes the role of the accountant in the terms of compliance. So these financial statements comply with the applicable framework, comply with the applicable regulations, and comply with the applicable legal requirements. The next is that they make sure that this financial statement present a true and fair view of the state of affairs of the entity, and they do this through the audit committee. So the directors are to ensure that the statements are not showing an overstatement and the statements are not showing an understatement. So they present a true and a fair view of the affairs of the entity. The next is that they ensure that appropriate and adequate financial reporting system are in place. It is the role of the directors to ensure that all things are in place to ensure that financial reporting takes place as and when due, in a timely manner and in a manner that will ensure the growth and progress of the business. And the last that we have here is to approve annual budget and ensure adherence to the budget. It is the responsibility of the directors every year, and some even do it quarterly, to ensure that the budget is in place and there is strict adherence to the budget. And if there is need for a revised budget at any point in time, it is the responsibility of the directors to do so. Users of accounting information. So we have two users of, or we can categorize users of accounting information into two. We have the internal users and we have the external users. Let's start with the internal users. In accordance with the ICANN study pack on financial accounting, we have three internal users. Those are the owners, which are regarded as the shareholders. We have the managers, and then we have the employees. Who are the owners? As I rightly said, the owners are the shareholders, and the shareholders are interested in the financial performance and position of the business. They need to ensure that there is return on their investments, and they assist in making informed decisions about the business. The managers use the financial information to make strategic decisions. For example, how to move the business forward, on cost minimization strategies, The managers also need to look at revenue optimizing techniques and so much more. While for the employees, they're interested in the financial stability and profitability of the business. The employees will need to look at through the financial information, they can know their job security and potential salary increases. Now going over to the external users, we have a lot of external users which are even more than what is written here, and we have investors. Investors, people who are potentially willing to invest in the business. They use the accounting information to know if the business is viable, if the business is a profitable venture. There as well, we also to have lenders. For example, before borrowing to a company, they need to know, oh, is the company viable enough, and so many other information. Suppliers, customers, government, financial analysts, and the general public. We see that public listed companies are expected to publish their financial statements, and the essence is so that the general public can have information on the, or they can have a hint on what is going on in such companies. Going further, let's look at the basis of accounting. In the preparation of financial statements, there are three bases. Firstly, we have the accrual basis, next we have the cash basis, and thirdly we have the breakup basis. Let's start with the first, accrual basis. The accrual basis of accounting. Now let's listen carefully, because based on this, further classes that we'll be having will be based on this. Now, the accrual basis of accounting recognizes transactions and other events in the accounting period in which they occur, not when the associated cash is received or paid. Let's take a contrast with this and cash basis before I tell the difference and before I explain further. Cash basis, on the other hand, recognizes transactions, other events and conditions in the period in which cash receipts and payments occur. Now we see the difference. Accrual basis is in the period in which they occur, not when cash is received or paid. While for cash basis looks at its own, not in the period that they occur, but what concerns us is when cash is received or cash is paid. And let's now look at it, for example, concerning revenue. Let's take an example of revenue. So a company sells 100,000 worth of goods, 100,000 naira worth of goods. Under the accrual basis, let's say the company sells the goods in year 2020. So it is in year 2020 that they will record that revenue. But cash basis is telling us that, oh, the company may have indeed sold 100,000 naira worth of goods in year 2020, but the goods were paid for in year 2021. So we would recognize the revenue in year 2021 and not year 2020. This can as well happen for expenses. For example, a company can incur expenses in year 2023, but they have not yet paid for those expenses in year 2023. That is what accrual basis is saying. Okay, recognize it as an expense year 2023, because that is when such expenses occurred. But for cash basis will tell us on the other hand that, oh, it was in year 2024 that we actually paid for it, even though it was incurred in year 2023. As we go on in further classes, we would explain it more, and then more explanation and more solutions will be given to it. And the third one we have is breakup basis. The breakup basis of accounting is applied to businesses that have lost their going concern status. In this situation, business assets and liabilities are measured at the amount of cash they can be sold for or settled. When we look at the concept of accounting, we would notice that every business is regarded as a going concern. A going concern means that they will continue for the foreseeable future. But when we now look at breakup basis, this business is now having, maybe due to certain reasons or due to certain conditions, the business can no longer continue for the foreseeable future. The business is ceasing or the business is winding up. So therefore, The basis of accounting for that particular business at that particular point in time will be on breakup basis, and then the assets and liabilities are measured at their realizable value, which they can be sold or settled for. Now, business. We see that everybody right now or the other does one form of business or the other, or is involved or in the line of business, one business or the other. What exactly is business? Business can be defined as an economic system where goods and services are exchanged and for one another or for money. We need to take key things in this particular definition, and the first one is goods and services. You can either trade goods or you trade services. That is where exchange comes into place. And this exchange can be for one another, which is barter system, or can be for money. So in simple definition, business is an economic system where goods and services are exchanged for one another or for money. It can also be described as an economic process that describe entities that participate in that process. And the entities, we look at them as we continue further. Now, under business, before we go into sole proprietorship, we have two categories of business basically. We have two categories of entities. We have business entities, and then we have not for profit entities. Okay, it's not stated in this definition, but I want us to note that the essence of going into business is to make profit. Let that always sink at the back of your mind. The essence of going into business is to make profit. I don't have it here in my slides here, but there are characteristics as well of business. We need to know the characteristics of business. And amongst the characteristics of business, it is important that we know that businesses are formed with a profit motive. Very, very important. And businesses operate by supplying goods or rendering services. Please let us write this down. They operate by supplying goods or rendering services. Another is that businesses take risk. For a business to survive, there is need to take risk. And according to the risk return trade off, the higher the risk, the higher the return. For one to succeed in business, there is need to take high level of risk. But it's not just high level, but reasonable level of risk. And the last is that profits made by businesses belong to its owners. If it is a sole proprietorship, it belongs to the sole trader. If it is a partnership, the profit is shared amongst them in the profit sharing ratio. And if it is a company, the profits of a company are indeed, they can be retained or they can be used to pay as dividends, as the case may be, or according to the dividend policy of such organization. Now let us know that entities are divided into two. We have business entities and we have not for profit entities. And under the business entities, we'll now be looking at three, which involve sole proprietorship, partnership, and limited liability company. Let's start with sole proprietorship. So any business owned and managed by one person is known as sole proprietorship. Any individual who sets up a business on their own without forming a company is a sole trader. Quickly, what are the features of sole proprietorship? No legal distinction between the business owner and the business. So it's almost the same. Let me even give examples of sole proprietors. We can say retail trade, we can say a tailor, we can say a barbering shop. All these things that are just done by one person. A catering business, it is just owned and managed by one person. But there is always a mistake that sometimes we always make. It is owned and managed by one person, but the person as well can have employees, the person can have people under them. But don't forget, it is owned and managed by one person, and there is a limitation in the scope of such a person. For example, you see a woman who sells food at the Buka Hut. Yes, it is still a sole proprietorship. You may say that, oh, but she has people under her. But don't forget the definition: owned and managed by a single person. So other features are assets and profits of the business belong to the owner. There is low financing requirements, and it is unlimited liability. Let me explain the meaning of unlimited liability. So if the company should wind up, if the company should come to an end, or if the company should go into debt, the debts that are owed by the company will be paid by the sole proprietor, and the sole proprietor can even go into his or her own personal assets in order to set off or to settle the debt. So the liability is not limited to anything. Your permit me to use the word, your gbese is not limited to anything. Indeed, e can go into your personal assets to repay off the debt. Now let's go into partnership, which is the second form of business entity. A partnership is a relationship between persons who have agreed to share profits of a business carried on by all or any of them acting for all. And we have features of partnership: association of two or more persons to carry on a business, no perpetual succession. This is in the case that maybe a major partner should die, or maybe the partnership should dissolve, then there is no perpetual succession, meaning that it does not continue. It is not a going concern. It does not continue for the foreseeable future. Then profits are shared according to an agreed profit sharing ratio. There's an agreed profit sharing ratio for profits to be shared. And there are many other features, but because of time, we won't be able to take them all. Let's quickly go into limited liability company. Now, in limited liability company, ownership of the company is represented by ownership of shares. We have a lot of companies. We have Dangote PLC, we have a lot of companies, you can name them. And the ownership of this company is represented by the ownership of shares, unlike partnership, unlike sole proprietorship. So a company has the status of a legal person recognized by law. The meaning of this is that a company can sue and a company can be sued. A company can sue another company, a company can sue an individual, and the company as well can be sued by a person or sued by an individual. Next is that a company is taxed separately from its owners for the profits made by the company. As we learn in tax accounting, we see that of course companies are required to file tax returns, and while they file their tax returns, the computations of their tax and all other supporting documents, it prepares them to pay a profit on the tax that is made. And lastly, here we have a company is liable for its own debts and not the shareholders. So the company sets off its debt. It is not the shareholders' money. That's why there is limited liability. Notice the word limited liability. So very quickly, let's go into not-for-profit entities. These are entities established with the aim of providing social and welfare services and not necessarily for profit motive. Features of not-for-profit entities: members pay subscription to maintain their membership. So we see cases of membership subscription in not-for-profit entities, and entities do not prepare statements of profit or loss, rather they prepare income and expenditure accounts. So this is where we'll be stopping for today. I will advise that you tune in, because more videos will be uploaded as time goes on, as we'll be looking at other topics and as we'll be learning more. So my advice to you is that keep the fire burning, keep being inquisitive to learning, and thank you for listening.